Hi guys, welcome back to the Wealth Kofa channel. In today's episode, we are going to dive into what people mean when they say do your due diligence when it comes to investing. So here are some of the things you should look at as you invest. The first thing is either a lump sum or a small investment. Some investments allow you to pay gradually in installments versus others require lump sums. I'll give you a good example. A money market fund allows installments. It allows in both installments and lump sum, but most people tend to pay in terms of installments versus a government bond. An infrastructure government bond requires a lump sum. An initial lump sum amount of money. You don't pay lesser than the what's it called? There's a certain term, I'll put it on the screen. So that's something you should consider. Are you going to do smaller investments or are you going to go with a lump sum? Okay. And then another thing you should look into when investing is your risk profile, your risk appetite as an investor. Don't go jumping into forex investments when you know very well if the numbers go low, you're going to suffer a heart attack. Don't go investing into high risk investments if you prefer slow, steady growing investments. I'll give you an example. Some people prefer investing in land as opposed to investing in forex because they know land they can see and that is their preference. They are like a low, very slow investor risk appetite. They have little to no risk appetite. When they see they don't want to look at the numbers going up or down, as opposed to people that invest in crypto, a higher risk, because crypto is a higher risk investment option. Okay, so there's various quizzes online that will help you identify your risk appetite, but just a good rule of thumb, a good question to ask yourself is, what happens if I see the market going down? Am I going to suffer a heart attack? Am I going to panic? Or is this a good time for me to invest and buy low, sell high? It's good to know yourself. Don't lie to yourself, because we don't want you claiming that investing is a bad idea. Okay. Another factor you should take into consideration before you invest, and a good pointer, is the ease of getting your gains, the ease of getting out. Some people prefer that when they get into an investment, they can be able to get out within less than a year. Others are more long term. Okay, so for example, if you buy land, it's more of a long term than a short term, like a money market fund. Okay, and then another pointer of a good investment is the amount of money at hand, how much money you are willing to lose. Don't go investing money that you know it would have served a different kind of purpose, because then if the fund or whatever investment you've chosen loses its value, we're now in a big argument with the investment firm. Okay. Another factor you can take into consideration is your purpose of investing or your goal. So this is what I meant by long-term investor versus short-term investor, because there's investments that require you to be there, have that particular, for example, account for a longer period of time compared to others. An example again is land. Another example is like forex or crypto or shares in the stock exchange, because they tend to go up down all the time. So if you're a long-term investor, you get better returns versus short-term. You may not get as much returns in some investments compared to others. And then another factor is the duration of your investment. So how long do you plan to have this investment? If you hold some investment, the longer you hold, the more the returns, but and the lesser the risk. For some investments, the shorter you hold, the more returns, but also the higher the risk. So look into these factors and ask yourself these questions, especially before just jumping into an investment just because you have been told this is where the money is at right now. And then the last one is the growth and the cash flow. What is the benefit you're going to get out of this particular investment? Because there's some investment that give you passive income. Some don't necessarily give you passive income. They just grow your capital, the initial amount you've put in. An example is a government bond. The initial amount you put in is what you get out after the period of time. I'll put the correct terms on the screen. But every 6 months, you get an amount of money, a passive income stream. So a government bond is good if you're looking for that kind of passive income, versus a money market fund. What grows is actually the amount of money you initially put in, the principal amount. So which one are you looking for? Versus land, there's you could buy when it's cheaper and then sell when it's higher. That is how you get your return. Or you actually do an agricultural related project. That is also something you can consider. All this are very important. Doing your due diligence does consist of these things and way more, but I feel these are some of the essential things you should look into as you're choosing your next investment. If you have any questions or any comments on how you choose your investment options, please let me know in the comments. I'll be so happy to read your thoughts on this video. Thank you very much for watching. I'll see you in the next episode. Goodbye.